Welcome to NAAIM Confidential, episode 22. I'm this week's host, Ryan Redfern. I'm filling in for Ben Fox, who is out, who just had a new baby. So congratulations to Ben. Today we got Bill Overton, the certified financial planner from Advanced Financial Solutions in Boise, Idaho. Hey, Bill, great to have you on today. Good to see you.
Great, thanks for having me. Look forward to chatting a little bit, and this is really cool. Thanks for inviting me.
Absolutely, absolutely. And Bill, one of the things we wanted Bill on is he's a financial planner who also uses active management, because I think a lot of planners live in that very in the box world of allocations of the 60/40s and et cetera, and they really don't get outside of that. So it's great to see a financial planner who does a little bit of both and thinks in an active way that I think is beneficial. So let's start with the name exposure index. I know Bill does not contribute to it, but let me share real quick where we are.
But you're quickly guilting
Yes,
me into it, so now I'm thinking differently about that.
absolutely. You need to be a part of it. You need to be a part of it. Absolutely. So we've got currently 68. I should be sharing, right?
Yep.
Yeah, we are. Currently 68.65. If going back to Rob Hanna's work, if it gets below that 60 level, it's worth looking at a buy as a buy signal. So that's always a fun thing to look at. I know I think I reported 80 this week, so that's below where I am. So guess we'll have to see. So Bill, if you were to be posting it this week, what percentage would you be at? Would it be all in or you'd be out?
Oh, we'd be all in. Our active management strategy is fairly simple, I think, at least relative to some of the other ones I've seen through NAAIM. And
Sure.
we use a number of kind of trend following type factors and combine them into our own algorithm. But yeah, we're either in or out, right? And
Gotcha.
currently we're in, and we've been in for a while. So yeah, we're not super active.
Gotcha. So we need you in here to boost up this number for weeks like this. You'll help it swing. I think that's great.
Okay. Yeah. I mean, yeah, especially now, honestly, I don't know if this is a great excuse, but I think part of the reason why I was like, well, do we have to report our individual portfolios? Because our conservative portfolios are never, ever fully exposed. So you just always hold a core in there that's, non-equities. So anyways, knowing what you told me kind of beforehand that, hey, if we're kind of green light and we're exposed as we would ever be, then yes, we would be in. So that makes my job of maybe reporting a lot easier and more frankly compelling for me to do it. So yeah,
Awesome. Awesome. Well, we need to have you be a part of it. So I appreciate that. Yeah.
sure.
There are some who report plus 200 or negative 200, and that's what they report every week. So that really helps skew the numbers as well. Mine personally, I would go between, I think, a negative 60 and positive 190 on my model. So I'm a little more of the variations week to week. And some people are just big on risk off, risk on, risk off. But yeah, there's people who post to this are everything in between, from super crazy aggressive to long and short to, they're consistent. Every week they give almost the same number. So
Uh-huh.
everything is in there. So there's room. There's room for all kinds of thinking.
For all kinds. Good.
Yeah, and I think it was the vision to have it be a good broad cross section of a lot of asset management philosophies. So it's not just
Uh-huh.
one; it's really a mix of the whole community.
Yeah.
A good sentiment indicator for that. So, all right. So let's dive into you personally, or you and your firm. When you talk about your background, how you come at the market, what do you think? What's going on?
Yeah. So, I'll give you a quick thumbnail sketch of Advanced Financial. We're just a small RIA boutique firm. Until I came along about 5 years ago, it was a single, operator. And Dave, my partner, I'm his succession plan essentially, and he's got kind of one foot into retirement, and over the next few years, he'll be taking both feet in. So that's kind of the makeup. And we have a large financial planning component to our practice. Most all of our clients are financial planning clients as well as money management clients. Um, let's see. Yeah, we like to work with fewer clients and, offer more, services to them. So that's really where we do best. We don't we can, and we do have some that we just do some money management for, but that's not really where we're strongest from the standpoint of it's not as sticky. If, we're not super active. We're
Mhm.
just like focused on long term, and generally speaking, that's retirement. And
Mhm.
so our strategy kind of matches that. We are active, but the acronym for our strategy, it's STAY. So it's
Mhm.
strategic, active. Let's see if I can get this. Strategic, tactical. So it's strategic, tactical, active management for you. So it's kind of
Okay.
like, strategic is kind of almost like buy and hold, right? And we are kind of buy and hold, but we have some bounds on either end that says, hey, when things go past a certain point, it's time to shift. And we even use inverse when we're convinced we're in a downtrend. So you don't see that in buy and holders, but
No. No.
so but anyways, we're a little closer to buy and hold than probably a lot of folks are,
Mhm.
because we're doing so many other things. We don't sit in front of our computer and watch it every day, but we
Yeah.
do daily downloads and check and see, okay,
Mhm.
we don't want to be doing more than maybe half dozen trades a year, right?
Right.
If we have to, we would, obviously, but then we'd also be going, are we in the right strategy?
Mhm.
Um, and our money management strategy is really defensive in nature because, Dave, I was going to say, a very wise man once said, um, it, it's not that hard to make money if you're not losing it, if you're never losing it.
Right.
So it's kind of the tortoise and the hare situation, right? Hey, we're
Mhm.
probably not as high flying as some of the strategies out there, but we're also really limiting our downside risk in most scenarios. So
Sure.
yeah, yeah.
Well, limiting downside risk in especially in retirement accounts, I find is essential. I'm not even sure it doesn't even make sense otherwise to let somebody do a buy and hold if they're taking distributions and have to live off that for X number of whatever. I don't care how good the stock bond ratio is. They can both go bad together, like we saw a couple of years ago, and that does nothing for the clients if they're taking money out. Uh,
It's very, very painful, right? So
Yeah,
in fact, let me share a
yeah, go
quick
for it.
slide. It's very simplistic, but I think it really does a good job illustrating this. And this is what I use with clients a lot. So can you see that slide?
Yep, yep. Average
Let
rate
me.
of returns versus sequence of returns.
Right. So in the
Perfect.
kind of the question we lead with is, when does 5%, beat a 25% return,
Mhm.
right? You think, well, the average person anyways, who never thinks about this goes, that's impossible. You can't beat a 25% average return with a
Mhm.
5% average return. So if you look at this, it's very simple math. You just add 5% each year, you end up at the end of 4 years with
Mhm.
$127,628. Great. So what about the scenario where you had something that was projected to maybe do a 25% return, and it actually stays true to projection? Let's have a look. Um,
Right.
so yeah, year one, it obviously didn't come at you at 25% every single year, right? Year one, we did 100%. Year two, we did negative 50. Year three, 100% again. And year four, negative 50. And so if you do the average, right, you don't have to
Mhm.
have a mathematics degree to figure this out. You average a 25% return. Isn't that cool? At a cocktail
Mhm.
party, you can talk about how your portfolio is a 25% average annual, return. But I can sit there and go, well, what's the balance, right? Because
Yeah.
people do not understand the impact of volatility.
Mhm.
Um, and there's another subject that we really like to talk about, but we don't, our clients don't kind of glaze over when we start talking about the Ulcer Index.
Yes.
I'm
Yes.
guessing a good number of folks that would be listening to this would be familiar with that, but we love that because it measures the downside volatility in
Mhm.
combination with the recovery time. Um,
Right.
and the way it was explained to me, it's so simple, right? I'm not my partner, who's a mathematics degree and has been, heads down on algorithms on stuff like this for 30 years. He just goes, look, think of it like that triangle, the area of the triangle when it goes below,
Mhm.
So it could be a small dip, but it takes a long time to recover. That's a big area of a triangle. Or it could be, a deep dip with a quick recovery. That's also an area. Or the worst case, deep dip, long recovery. That area of that triangle is even bigger. So you think about measuring that, that becomes very, very meaningful to the things that are highlighted in yellow, right?
Right.
Whereas if you look at standard deviation, I mean, there has some value to that, but it gets watered down with all the upside deviation. Nobody ever complained about upside,
No,
volatility, right?
nope,
My,
not at
my,
all.
my, my portfolio is too volatile. It keeps going up. Well, okay, it's not a problem.
Yeah.
So anyways, yeah, we try to, especially from a planning perspective, it's really, really hard to plan if you don't have some strategy to deal with market volatility.
Mhm.
And it gets worse and worse, like you suggested, as you get into retirement and you start taking money out of your portfolio. You really can't afford, or at least most people can't or don't want to, like, have drawdowns in that scenario, right? So
Right. So you
it
said you go all in, all out on your equity side. Do you have a bond side that you mix that with to create
so
your
yeah,
models?
that's a great question. Yeah, we, as you mentioned earlier, we had historically used long and medium term bonds for our core
Mhm.
position.
Sure.
And so there's two uses for our core. One is to mix in with our equities position to lower the volatility in people who have, lower risk tolerance. That's
Mhm.
one purpose of the core. The other purpose of the core is when we go like all risk off, or what we call red light.
Mhm.
Um, we move 100% out of equities and just put everything in the core. That is, and so our core in 2022, oh, we timed the market great. We got out of equities at the perfect time,
Mhm.
well, at a good time, and
Sure.
and the problem is we moved into medium and long term bonds. And
Yeah.
historically, like as everyone understands, when the equities start tanking like that, those bonds tend to even have a little upward
Mhm.
propensity. And boy, they just went down at the same or maybe even worse than the bond. So we were like, okay, we pulled the ripcord on that pretty
Yeah.
quickly, and then we just went flat in cash until we figured out what to do. And so now what we're doing is a kind of a combination of um, for the core position, we will use some real short-term bonds. In fact, I think you helped us discover one of them, OPER,
Oh yeah.
and we also use GSST.
Mhm.
Um, and so
Yep.
those, we understand that those are not always probably going to deliver the
Right.
5 and 6% ish, returns, but for the time being, like that feels like a great way to have a core position
Yeah.
to either augment or offset what we're doing. The other thing that we're doing now, because when we went flat after that
Mhm.
scenario I just went through, we're like, well, what can we find that can deliver when the market's down and bonds are down? And
Mhm.
eventually Dave's conclusion was, well, I know one thing, inverse will do
Yeah.
well when the market is going down.
Right. Right.
Guaranteed, right? So yeah, we're involved with doing inverse as well, and when there's a no longer term downtrend, we'll
Sure.
march into inverse. And so that's a
Gotcha.
great opportunity. And we developed a little, tagline: bull or bear, we don't care. And so,
Nice.
sign up for your bull or bear, we don't care hat if you're
Right.
interested. We have those. I should have had one available
Oh,
to
that's
show you.
awesome. That's awesome.
Yeah.
So how do you go all in on the inverse, or do you do it as part of your long or your red green strategy, or how does that fit into what you do with,
So
with
yeah,
inverse?
when there's a few exceptions to this, but by and large, the rule is when we're in a red light
Mhm.
scenario, that means we're in inverse, right?
Okay.
But we are the aggressive account is going to be probably 80% exposed to inverse rather than
Okay.
100. And when we're in
Sure.
equities, regular equities, we're maybe 100. So we dampen it a little bit.
Mhm.
And we've also had to tighten the leash a little bit because we really don't want to be riding through much of anything, when the market's going up
Yeah.
and we're in inverse. So we have a pretty short lease when we're in inverse, but still,
Yeah.
it's a good opportunity, especially if there's going to be a prolonged downturn.
Right. Right. Well, you need to be. I mean, shorts historically are very tough. It's tough to make money on a short strategy, but it's very effective as a hedge, as a way to smooth things out in a quick short term way. So there are ways to make it work effectively. I just know a lot of people shy away from it, but I like you. I also use inverse funds to manage risk, to help deal with the downside or questionable volatility. I find that very effective. But I tend to like the more of a market neutral approach. Let's say I love the S&P, but I hate the Dow. I might buy an inverse Dow and keep holding my S&P and
Yeah,
keeping
yeah.
that spread, and that usually smooths it off. And in bad times, I had my accounts just kind of let go flat, and being in that position when things were just getting crushed. So it's a nice way to not have to do a tax sell, but then you can have a hedge on it to help deal with that as well.
Well, then, and I should mention this too. Because that's sort of an interesting thing to consider. Because when we are in, well, either way, invested inverse or just in equities, we have a pretty simple strategy, right? We'll take, let's say, in our aggressive account, and it's 100% invested. We'll
Mhm.
divide it into four things and say basically you're going to have S&P, Nasdaq, small cap, and mid cap. And then, for inverse, we're just the inverse of those four, right?
Mhm.
And if you're in a balanced fund, well, then you only get half the exposure, right?
Sure.
And the other half is in the kind of the core thing. So,
Yeah.
um, but uh, right now, that what we're seeing is that the Nasdaq and the S&P year to date have done fairly well, but the
Mhm.
mid cap and small cap have not kept up at all. So it's nice
Right.
to be diversified, except for they don't all perform the same. And now everyone's going, hey, how come you're falling behind the S&P here?
Yeah.
Well, you know, and on a different day when the small cap and mid cap are doing well,
Mhm.
we'd be looking good. But I get
Yeah.
that's
Yeah.
that's diversity for you.
No, sure. I find another way to deal with that is look at the growth value ratio and kind of letting that guide you as well. Uh, and because sometimes it's like right now, there's no reason to be in small caps. It just doesn't help. I mean, maybe for a day or two, and then you give it all back. So I'm kind of like, if
So
shy
yeah,
away from that, just
talk
overload
more
and
about talk
yeah.
more about the growth value. Like, how do you measure that? What do you
Oh,
where are you looking?
just as like a relative strength chart. You can do asset A divided by asset B, and you get a chart of it, and you can put a moving average on it. Look at it weekly or daily or whatever. The Chad Carnes episode I did for Name Confidential a couple weeks ago. We talked all about this for quite some
Uh,
time. But
uh-huh.
yeah, just looking at the ratio between different asset classes, between large and small, between growth and value, and that can helps us lean into the right side of where the strength is in the market. Then you have fewer of those. Why aren't you keeping up? Because gross beating it right now. It just is. But it wasn't 2 months ago. So it's good to be able to go, oh, hey, I should lean this way a little bit. And you don't have to go all in. But
Yeah.
it certainly helps guide you.
Right.
And help for me, I like to stay out of the stuff that doesn't work. So
Yeah. Yeah. Well, hey, there you
I feel
go.
like it's lazy, but I'm just like, no, I don't want to. If small caps are garbage, I don't want to own them. So
Like I said earlier, a wise man once said, "It's not that hard to make money if you're not losing it." Right.
right. Absolutely. Absolutely. Same with bonds. I found bonds are brutal right now. So we're leaning more into that floating rate and the short term stuff like you talked about. That's if you can make 5% with relatively low risk, I'm not sure why you want to jump into bonds just yet to take that big risk and try to get a little more than that. That's not a bad number.
No, 5 is great
No, for
for
the
that.
safe part of your portfolio, I'm perfectly happy with that.
Right. Yeah,
Yes.
that's been an amazing benefit of the shift, right? But now, next time around, in
Yeah.
25 years, I'll be like, oh, let's see, what's happening with interest rates is probably going to really have a massive impact on these long-term and medium-term bond funds.
Hmm.
And I'll be able to see that one coming, but I didn't, and I don't know that how many people did, but
Yeah. Yeah. I find the relative strength charts help with that, but yeah,
hmm,
that's a thing for another day, or I'll certainly share some with you after this if you want. Um,
cool.
so you kind of earlier you said planning, you have a specific client that's ideal for what you guys do. What could you kind of paint a picture of how that works and how planning fits into that?
Yeah, for sure. So, we when we explain our firm to new or prospective clients, we tell them kind of, two things, right? We have two kind of founding pillars that we build our kind of value proposition on. One is, avoiding market crashes, right? And so, like we've already talked about, being defensive and active and all the things that, we all
Right.
talk about all the time. So essentially boil it down to one word: crashes, right?
Hmm.
Um, and then the other word that we build our practice on is taxes.
Okay.
Not Texas, but taxes.
Right.
So,
Yeah.
yeah, there's so much that can be done in the tax planning realm if you're willing to plan out more than a year or two.
Mhm.
And we've kind of become charitable giving specialists in our community. We have a lot of folks that are already charitably inclined in our kind of our personal network, Dave and I both. And so, um, particularly for people who are already going to be giving, it's like, whoa, 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 let us teach you how to give in the most efficient manner possible, right? And there's so many things that could be done for people who especially have appreciated assets, right? And of course, we think of stock, but oftentimes it's like real estate. And in particular, I'll just give it a great example is like textbook example is a rental real estate.
Mhm.
And people go, well, I guess I've had this rental for 20, 30 years and
Yeah.
it's almost depreciated out. And so I guess I'll just do a 1031 exchange because if I if I have to actually just and then a lot of people are starting to get older and they're like, do I want to continue to toilet tend and all the things involved in
Yeah.
being a
Right.
landlord? And they're like, I don't know, but man, I have such a low basis in this. If and then the depreciation recapture comes at you,
Mhm.
you're like crazy, right? Probably even as big or bigger in a rental situation where they've had a property for 20 or 30 years, because that comes back at you at a much higher rate than the capital gains, right? So anyways, we've done a ton with clients that have these things, and we can do like a charitable remainder trust,
Mhm.
and we move the asset into the trust and then liquidate it. And since it's a charitable trust, it's not subject to tax,
Oh, wow.
which is great. But like in an annuity trust, you set it up to get that money back to you over time, right? And so as it's coming out, it is well, first of all, the depreciation recapture completely goes away, but it's still coming at you as a capital gain. But the beauty of it is if you know about capital gains rules, you can get up to $80,000, and that number, if you're married, filing joint, it's in the $80,000 range every year, and the percentage is zero, right? And when you get above 80, then it starts to get to the different tiers that top out at 20%.
Mhm.
But what you do is you start to feather this out. You're effectively creating like an installment sale, so you don't have to deal with that entire lump at once, and then you're basically chopping it into small pieces that are more easily digestible from a tax perspective. So that's just like one kind of
Sure.
simple example, right? And of course, there is some money that will go out to charity at the end of the charitable remainder trust.
Right.
But essentially, it turns out to be, whatever, maybe 5 to 10% of the asset, which again is far less than you would have paid if you.
Oh, sure.
And a lot of people are like, well, then I can do my charitable giving out of that, and then my cash flow, what I was doing my charitable giving before, I don't have to use that for charitable giving, right? And so when you have a few different things going on, it can be really, really exciting for clients, and then they're giving more than they ever thought they could, and they're keeping more than
Mhm.
they thought they could. That's
Yeah.
when charitable strategies are done well. That's usually the end result. So anyways, I got on a tangent there, but
No.
the tax planning is huge, right? And just doing things like Roth conversions and looking at when and how to do those in the most efficient manner,
Mhm.
um, can over time yield great results for people's long-term
For sure.
profile.
And
So
I'm finding or maybe realizing more and more that so many CPAs don't do tax planning. They tell you like what's good right now, and there's nothing about how this will help you in 5, 10, whatever years, really not beyond next year. And I
yeah,
find that fascinating.
it is fascinating because most people are like you and they assume, oh, a CPA is going to, they
Mhm.
deal with taxes, they're going to help me.
Yeah,
Well, yeah, if you ask almost to a T, if you ask every CPA or almost everyone, hey, are you a tax preparation person or a tax planning person? They're going
yeah,
to say, well, no, we do tax preparation. That's what you pay me for is tax preparation. If you want tax planning, you got to either go to that. They could possibly do tax planning if you paid them to do it, but they're only getting paid to make sure you're reporting what happened in the past to the
right,
IRS in a way that's accurate and acceptable and according to the rules, right? They're not getting
right.
paid, they might say, oh, actually, if you just made a bigger contribution to your tax deferred account,
Right.
you could kind of sneak under this particular wire for this year.
Hmm.
But we're always going, why are we creating a bigger tax liability
Right.
and I can give you a whole speech on what I think the future of taxes is and then show you charts and things that it's like unbelievable. The future of our tax situation is, it's like the market. I don't know exactly what and when it's going to go, but I do know over time, like, taxes will have to go up, mathematically speaking, right? It's not rocket science, right?
Right.
So, anyways,
Right.
yeah, that and so all that to underscore, like tax planning is super, super valuable and super,
Mhm.
super important, and I think it's only getting more and more important and more valuable. And
Yeah.
for folks who are leaning in, maybe I should do maybe some more planning or have some of that. I think look into just educating yourself on the whole what can be done from a tax planning perspective. And the cool thing is too that it works really nicely with the money management is where we're adding value is with people who have more assets, right? And so
Right.
naturally that we're going to be able to manage more money, right? It's not that unusual, right? That people who have multiple rental properties probably also have, a decent amount of IRA or whatever that needs management. So
No,
yeah.
for sure. For sure. Well, awesome. Awesome. And is there any sort of like software that you used to do that, or is it all just spreadsheets, or how do you come at it?
So yeah, we are using a few different softwares, but the main planning software we use is a pretty well-known one called eMoney, which
Oh, okay.
yeah, I think it's good. I wouldn't say it's
Mhm.
awesome. It's certainly
Sure.
expensive, that much I will say. But
Right.
I think that when you want to get really detailed and granular and nuanced, it can be frustrating, right? I had a client in my office yesterday who wanted to see, she has an asset, which is essentially she sold her rental property, but has kept so the person who bought it is basically paying her.
Hmm.
And so there wasn't a good way to model that in
Right.
eMoney. And it's like every year the tax profile is different because she's
Yeah.
taking in a different amount of principal and a different amount of
Mhm.
interest, right? It's just like if you
Right.
look at your mortgage amortization, same deal. And so there's no way to accurately model that. So it has limitations, but in
Okay.
general, it can provide some great projections and visualization for clients,
For
which is
sure.
really good.
For sure.
Yeah.
Well, all right. We're about time, so I got to ask the final questions of: do you have a favorite investment quote?
Well, I've given the same one a couple times today. Maybe I'll just stick with that, right? It's not that hard to make money if you're never losing it.
Love it. Love it. That'll work. And then how can somebody get a hold of you if they want to talk to you or ask you questions after this episode?
Happy to. You can find me on LinkedIn. You can find me on our website. You can email me, Bill at afs-idaho.com, which is our website,
Okay.
afs-idaho.com.
Perfect. Perfect. Awesome. Well, thank you so much for being here. And glad to
Absolutely.
have you joining the name exposure index in the future. That'll help. And
Yeah.
I think you guys are also putting together a financial planning group for NAIM, because I think there are more planners in this group than people realize. There are a lot of more and more planners are getting into this tax planning, into active management, into protecting assets
Yeah.
in a way that I've not seen in really ever. So
Right.
I'm glad you're a part of that. And if people want to be in part of that, certainly get a hold of me, Susan, or you, and we'll get that group going. I really appreciate you being
Yeah,
part of
yeah,
that.
we got a good core of people that are it's interesting because we all are planners, but we all kind of have a different,
Mm.
way to operate, and it's great. We learn from each other and share ideas. It's awesome.
No, that's what NAIM's all about. So thanks for being a part of it, and thanks for being here today.